Tell you what, when volatility increases, people do really stupid things. It becomes increasingly difficult to trade in this particular environment. So today's video, it's a weekly recap. We got a lot of stuff to talk about. We're going to have timestamps in the description below. If you're new here, well, welcome to the channel. I use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. I'm going to be going over an array of stock market signal charts. We're going to be going over the indices and some key levels, some things that I'm paying attention to, and also in the conclusion section, kind of give you an idea as how I am approaching the markets at this time. Let's get into it. Hello, welcome back everybody. We're going to start off looking at some of the sectors just to give you a good idea and view of what is taking place as of right now. So if we take a look at the week-to-date performance and you look at the 11 sectors in the S&P 500, the top 3-4 up here, you're going to notice that the majority is all defensive names. So there's been defensive posturing taking place this last week. Utilities was the leader, real estate, then we have tech was slightly down, and then from that point everything was really down. We have consumer staples up there too as well. So market's kind of on defense as it stands right now. If we take a look at a relative rotation graph, well, you can see here the last 5 trading days. So last week, utilities is the strongest performer, and you can even take a look down here and you can see the S&P 500 fell right here. So anything that was performing from better than the SPY is going to be above that specific line. And you can see utilities was up 1%, real estate defensive, tech was down slightly, and the consumer staples also. But you can see here visually that XLRE moved into the leading category. XLP is improving and turning up, leading into the leading category. And then actually XLK, it is far over here to the right-hand side and is in leading category, but you can see it kind of turning itself around as it stands right now. And then you have financials improving, healthcare improving, energy also moving into that improving quadrant as it stands right now. Let's hop into the S&P 500. Okay, you're probably be wondering what this pink box is right here. This pink box is the expected move that the options market has priced in going into next week. So if they are correct, we'll see a range from the high end. It's plus or minus around 160. I believe that the study from the Theo team, they said at 68% or 65% of the time, the options market is correct, meaning that it'll land within this range coming into Friday of the following week. So we'll see if that is the case. Now, what I want to pay attention to from a technical standpoint is the S&P 500 on the weekly time frame is still in a bullish trend. If you take a look at the 30-week moving average, it acted as support right there. If this comes down and tags the lower bound of this, what the options market priced in, where would that take us? That would take us pretty much right to the 30-week moving average. So there's a lot of confluence of support there. Now the market would be very scared, right, if this pulled all the way down, a few more 100 points in a very quick period of time. But you need to be prepared for if you are a potential dip buyer. Now volatility being this increase and the range expansion taking place, you still need to be very careful and manage risk in this current environment. Now, if we take a look at the expected move of last week and we just take a look at the daily time frame, you can see this is, we were looking up at around 4725 and then 4475, and you can see the options market was correct. It landed within that expected move, and we tagged the lower range of this almost, and then also tagged with the confluence the 100-day moving average, and we kind of got bid from that specific point. So, the options market is pretty intelligent. So we saw all this volatility, and the people that did not pay attention to the market volatility was probably more scared. But this, you shouldn't be scared about it, especially if you knew it, that could potentially happen ahead of time. Now, in the grand scheme of things, let's go ahead and take a look at the SPX on the daily time frame and just kind of zoom out, because there's a lot of fear right now, and rightfully so. That happens when there's volatility. But if you just take a look, really it's still within an up channel. That was a horrible drawn channel, but you get my point. Okay, and you can see here that we are seeing these big volatile swings right now, as the market could be in a period of distribution, but as it stands right now, it's still above the 100-day moving average. Can it potentially head lower and hit that 200-day moving average, which lines up pretty closely with the, where is it at? The 30-week moving average, right? The 200-day moving average is at 43.05. This one is at 44.21. So it's basically the 200-day moving average of the 30-week, as close as you can get. So can we potentially get a tag there? Is the options market going to be correct? If that's the case, not only is it in line with the 30-week, the 200, but it's also in line with this prior low right here. So if you're a dip buyer and it comes down here, you need to be prepared, right? So we'll see if we can get that. Let's look at the 15-minute time frame. This is where the majority of traders, retail traders, they'll get their heads chopped off here. It's crazy environment. Just look at, and we've been talking about this, the 5-day moving average is bold and holding as resistance. We've been talking about the bear flags forming, right? It's still all over the place. Okay, so from a bearish perspective, it's still lower highs and lower lows. So the trend remains down. From a bullish perspective, well, it's been heading lower, but there's been positive divergences still continuing to build and hold on this specific time frame. So are we going to continue to see these rip ups and it's going to keep on doing this? There's a strong possibility that takes place, and it's going to continue this volatility. The options market is pricing in more volatile swings. So it could, by the way, which is crazy, if the options market wants to hit the upper range of the expected move, that's going to put us right back at all-time highs. So it's literally telling us, hey, we can go hit all-time highs and we can have that Santa Claus rally, or we're going to start breaking down a little bit more, and more fear and panic is going to be taking place. It's just a very difficult environment, obviously, and it's very hard to determine and or predict when there is really no consolidation, right? It's just wild swings, right? It's sucking people in here, dumping on them. They get out. You see a rip up. They're like, okay, now up, and then they get dumped on there too as well. They're buying in at the wrong time and they're selling at the wrong time. It gets very, very difficult. Let's look at the Dow Jones. Dow Jones Industrial Average tagged that lower weekly Bollinger Band perfectly. Okay, just slightly below it, and then we bounced. That was a level that we were looking at the previous week. It still holds right here. You can see these lower wicks all throughout the chart. Bam, 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 bam. However, what's the negative aspect to this? Well, look at it closed well below the 30-week moving average. So we need to see this area get recovered to feel a lot more confident that we can bounce up from this point. And by this level, this area, I want to see the top of this candle get taken out and close above on a weekly perspective to feel more confident. And that high was 35,287. All right, let's move on to the next chart. Okay. Dow Jones Industrial Average on the daily time frame. The daily time frame, you can see here, pulled into the 200-day, still holding there, a little hammer candle from that. Nice, okay, but still obviously very volatile swing to the downside. You can see how volatility is kind of just all over the place. It's been going up, down, up, down, up, down, up, down. And then when you take a look at the left side of the chart, from where we are to the left side, I mean, shoot, we haven't gone anywhere since May. It's been going absolutely nowhere, but we've been seeing the volatility and these swings, get more and more violent. Here's the DIA on the 15-minute time frame. We have highs that are lower, and we have lows that are lower. Okay, but very similar story here. We remain in bearish context below that 5-day moving average. However, you can see that the bulls are putting in these positive divergences. So the bears are getting weaker on these push downs. Now that can change, but it's something to still point out, because we might have the volatility, but you never know. If we start taking out a previous high, that can start changing, obviously, the way that we are going to have to position ourselves. And by that I mean, if we take out this trend of lower highs and lower lows, and we start putting in, well, a higher low, and then a higher high, and then a higher low, and a higher high, that will start to obviously change this chart, and it'll go from bearish context to bullish context. It's a process. All right, let's go to the Nasdaq 100. Nasdaq 100 down 1.96% on the week. Pretty violent week. We got to take a look at those big tech stocks still, right? So some of them have been getting closer to the 50-day moving average. That's still inclining. As it stands right now, the index just about tagged that 20-week moving average, closed well below the weekly 5. So the bears in the short term, they have the ball right now. What can we look to potentially bounce from if we get more stronger selling? Well, we bounced right from the 30-week here, right from the 30-week here, right from the 30-week here. The 30-week is still inclining at this particular point in time. So watch the 30-week. Watch the 30-week moving average, and that could potentially act as another area of support, and or at least at minimum a good risk to reward trade, even if you get stopped. Now, the Nasdaq 100 on the daily time frame, we talked about this negative divergence. It's playing out. And we also discussed about this possibility for an inverse head and shoulders, or sorry, a head and shoulders, not an inverse. And we did crack that neckline and we started moving down to around the 50-day. It's very possible that we get back tests. And if we do head lower, a 10% correction will bring us to around this 15,250, kind of this zone in here. Okay, so that's always a possibility to watch. Like I said, we'll get some more clarity on our signal charts. But in the grand scheme of things, what do we got to look at? Well, it's still in an up channel, right? It came right to the high end, to the low end, to the high end, to the low end. And if you just look at the middle of the range, where are we at right now? Right there in the middle of the range. So can we come down lower and potentially hit the lower end of this channel? Yeah, absolutely. It's more than possible. But there's also a possibility that we just cruise around in the middle of this channel too as well. Okay, so we're still in bullish context. The Q's on the 15-minute time frame in the shorter period. Now this one does not have the positive divergence anymore as it stands, but you can see here in the shorter term time frame, the 5-day moving average, it's in bearish context, but it's rather neutral because, you know, just on this chart, it's kind of just up, and then slightly down. So we'll see here if this continues to get more momentum to the downside. Now, also to note, obviously, we have high, lower high, lower high, low, lower low, lower low. So we need to change this by what? Taking out a high and putting in, obviously, a higher low. Once we start doing that, we can feel a lot more confident that the tide may be shifting. Let's look at the Russell 2000. Russell 2000. This is kind of interesting. So this is a weekly time frame, and if I were to just draw out, and I posted this on Twitter, but if I were to draw out this trend line right here, this actually lines up with a very long-term chart. Now, this price action right here, that is a complete just collapse right there. So we broke out, oops, false breakout right here, and then we started collapsing, but now we're pulling into an area of support. So this still can very well be a potential hedge long, you know, if you like stepping into a lot of this volatility and a lot of this fear. You just need to, once again, continue to manage that risk. If you get stopped out, get out, because stocks can head lower. You don't want to buy the dip and then have a stop here, stops you out, and you're like, nah, no, I'll just hold on to it. Then all of a sudden it comes back and you're like, see, I knew it'd come back, and then all of a sudden it goes like that. Right? You just need to stick to a plan, have a plan ahead of time before obviously just jumping in for the sake of jumping in. Now that trend line that I was talking about that goes way back is looking at this monthly time frame. This is pretty much since the inception. This is all the data I have of the IWM, the iShares Russell 2000 ETF. And you can see here it's resistance, resistance, resistance. It's acted as support. We had an exhaustion break, but it came back in. Support, exhaustion break, acted as support, came back in, and now we're getting back out. Is this right here an exhaustion break and we're going to come back in? Hey, maybe, but as you can see here, resistance, 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 resistance can act as support. So we'll see if this gives way. We have the 20-month moving average that we can pay attention to, which is at 214. And then even from a stronger move to the downside, we have resistance at this level, resistance at this level, which means if we do have a strong move, start looking at 170 as a potential area to buy the quote-unquote dip. Resistance once broken can turn into an area of support. Another thing to call out though is we've once had a PMO bearish crossover here at a relatively high level, and if you just look up at 2014, the market didn't do much at that specific time, and that lasted for multiple years. And we can see here we're starting to curl back over from this kind of overextension area. And so if it does go down or go back up, we might not go somewhere for quite some time. So that's also something to consider. And honestly, we haven't actually gone anywhere for quite some time. And shoot, if you just look on this chart, each candle represents a month. We haven't gone anywhere really all the entire year for small caps. And I'm looking at a chart of micro caps. It's not on here right now, but micro caps broke some key levels too as well. And that's important, obviously. Okay, if we take a look at the daily time frame, you can still see, still obviously within this channel too as well. We broke out. We came back in, we're at the lower range. Let's keep on moving on. 15-minute time frame. You can see here, volatility shaking everybody out, going back and forth. The 5-day moving average clearly in a downtrend, lower highs, lower lows. However, the momentum continues to put in higher lows. So, you know, perhaps this will play out soon. Perhaps it can be a quick move. Maybe we get that. Maybe it keeps on continuing. But you can kind of see something interesting here is the swings are kind of compressing. Like we had a big move here, big move, big move, big move, big move, smaller move, smaller move. Perhaps we get a smaller move, smaller move. So basically what that means is we have expansion in this range, contraction in this range. Contraction can lead to expansion. That's not directional bias. It can go, up or down. But like I said, contraction, big moves, they end up contracting and then they lead right back to a large expansion. So if we are contracting right here and we break out to the upside, it could be a very strong move. All right, now it's time to get into some signal charts. Got quite a bit to go over, and I'm going to show you some interesting stuff that potentially can lead us to seeing a pretty aggressive bounce, actually. All right, let's first start off with the NIAD. This is the advanced decline issue line. The first thing that I want to call out is this. Pulling to the 200-day moving average. The cumulative line is pulling to the 200-day moving average. That can act as support, and it's in a previous area of support too as well from the cumulative line perspective. Okay, so that's one thing. Another thing to call out is if we take a look at the SPX, it actually cracked into a lower low, but you can see here it actually put in a higher low on the cumulative line. Not only there, but it also did right here. So that is a positive divergence. That is actually a good thing to see to potentially get some sort of a bounce. Is it guaranteed? No, but with strong moves in the market to the downside, large range candles, typically, think of like a rubber band, right? A rubber band, if you stretch it out, whee, and you let it go, it snaps back into place, right? And we could see something like that happen. All right, let's move to the next one. This is the NIAD advanced decline line, but I'm just showing you in a different perspective so you can see still positive divergence. You can see price action went lower, but you can see here it is showing that there is strength in the internals. It's still a low reading, but there's strength building a low, a higher low, and a higher low, whereas the price action is not quite displaying that yet. All right, let's keep continuing. This is the summation index and the NIMOT. And what we called out here in multiple videos is when they hit below zero and minus 300 reading together, you can have some aggressive type sell-offs in the market. Well, it looks like we did, but we were actually around 5 points off on this swing. So it looks like we tapped it. That's very close. So that's kind of just one of those things I want to say, okay, yeah, if that's the case, just be very cautious that in the market, by the way, the options market is already pricing in a lot more volatility. So it could be very well right. So that's why I'm just, on this chart, I'm just explaining that, it's not quite clear as to what could happen. However, it is clear that you need to be very cautious and manage your risk. Now here's the CPC, the sell indicator triggered right here. Bam, and if we just look down, it tagged it. I mean, that's once again, great reading. It's been doing that multiple times, right? It's got great readings on sell signals. So right here, yep, it started selling off. Now, the reason why I'm showing you this now is if you look at the CPC pulling like a 1.15, it's a pretty big spike up. And you can see the 10-period moving average is flying high. All right, so what does this mean? Well, if you see this as a sell signal, you can also look at this as a potential buy signal. What do I mean? Well, when it gets above this green line or even above the blue line, the 10-period moving average, and then it crosses back down below it, so it goes above and then crosses down below, very similar to how this goes below, that's warning, but when it crosses above, that's that quote-unquote sell signal. Well, when it crosses above it and then below it, if you take a look here, bam, that's when the market rallied. So it can be used as a potential buy signal. So we'll keep a close eye on that as it's heading higher and higher. Now, volatility closed at a 30 handle, 30.67. Now, it typically does not last. So volatility rises and falls. So it typically spikes up high and then it draws down. So the reason why I'm pointing this out is this is where the market can potentially bounce, being such a high reading on the VIX. Now, it's not a guarantee, but if you want to, add to your arsenal of ideals in your favor, the fear is very elevated. We're seeing some positive divergences. What we can look for going into next week, if we get a gap down in the market and then that candle turns to red, that could be a very good sign that we're going to get a bounce. We might not get the gap down. We don't know yet. We have to see what the futures market does. From a technical perspective, the VIX has been putting in higher highs, higher lows, but I will say the RSI has been diverging. It's kind of creating this rising wedge pattern. So it's a possibility, being that volatility is so high, that we could eventually crack down through this, and then that will lead to a bounce in the stock market. Now I've been saying that there's a gap, okay? A gap that's still above us that can very well get filled. And that gap is at around 44 to 45. So I pulled that up, and that gap was here since April 20th kind of range right in here. Okay, so if the VIX wants to head higher, I would be looking at that level as another potential area to hedge long. And that means the VIX would have to start ripping from here too as well. But you want to really be prepared and execute on some various long positions if that is the case. At least from a risk to reward standpoint, that would make a lot of sense. Okay, let's look at the NYMO. One thing that I want to call out here, right? We've been overextended. We're starting to come in a little bit. Market put in a lower low. This is putting in a positive divergence as well. Okay, so if you're looking for ideals in your favor for a bounce, right? Volatility is high. Typically doesn't remain high. We typically see it get, spike and then subside, and we're starting to see these positive divergences. Okay, NAMO. Positive divergence. Okay, that's another one. Let's keep going. There we go. The next one. This is the Nasdaq Cohen high-low. This, I pointed out, helps you find a bottom. So I'm not calling it out specifically because it's, really when it gets to this 0.05, that's been helping to find some significant bottoms. But what I did notice that I want to just point out is it's at this level. And when I actually looked at this, going back to late 2007, it actually came right into that level before, okay, and then bounced from this level. And you can see here, actually in 2007, the market was ripping. Then there was actually a lot of fear on this little tiny pullback. And that little tiny pullback lent itself to another rally higher, which was the top of that great financial crisis before everything started kind of rolling itself over. Now, I'm not calling for a financial crisis, but what I am saying is we have this big, huge move, right? Everything's all gravy, but then we're starting to pull back slightly into a very similar type level that's acted as a level of support previously. So there's a possibility that also lends that, hey, if this indicator starts turning up, we can very well, like seeing all these positive divergences and increased volatility, see a melt up or a move higher potentially. Okay, now from a negative perspective, what I do find interesting is the XLP over SPY. So this is consumer staples, which is more defensive name. You can see this is the relative strength line. So when this goes down, that just means that the SPY, the S&P 500, is outperforming a defensive sector. And you can see it's been going down, right? But there's a couple things to call out. For example, leading into the great financial crisis, it was heading lower. But on the rock, the rate of change, it was putting in higher lows, being a positive divergence. When the financial crisis took place, we saw consumer staples, a big move from a relative standpoint. Now, they both went down, but on a relative performance, consumer staples outperformed by a massive margin here. And you can see here what's taking place is we not only, as of right now, have a positive divergence continuing to build on the RSI, but we're seeing something very similar take place on the rate of change here as well, as the performance has been obviously putting in a lower low. So you never know, right? If this starts playing out as a positive divergence, perhaps, and we get some more fear in the markets, consumer staples leading into 2020 might be a better performer. Okay, we don't know yet, but I wanted to call that out. Now, if we take a look at BP charts, very overextended, right? They can stay overextended and overextended for a long time, but we're getting a 10 reading. That is very dramatic, actually. So, for example, just to give you an idea, a 10 reading right here is basically what we got at the pandemic low. So, are we overextended? But that's what's so weird about it is we're still relatively not too far off the all-time highs. So very, very interesting, perspective piece of information right there. BP NDX chart also getting oversold. What I like to see is positive divergences build in these. That even lends more to, just potentially finding a bottom. You can see that actually took place right here, right? We came way down low and then we put in a higher low. You can see here on the BP chart, it was a low to a lower low, and even here on the market it was a low to a lower low as well, and that lent to seeing a big bounce obviously in the markets. Let's take a look at the BP SPX chart. BP SPX chart also getting burnt to a crisp. So think about this. Everything is getting burnt to a crisp right now. Various stocks are completely getting obliterated. What does this tell you? The market's not going to go straight down. It's going to see some aggressive bounces, very similar to what we've actually been seeing these last 5 trading days. Okay, with internals that are just this burnt up, there's going to be one or two things that happens. We're either going to see this market start to rip to the upside, or things are going to continue to perpetuate itself to the downside. Okay, so you need to be, once again, very tactical in this market. Another indicator that I post on Twitter that I want to share, this one I shared right about there actually when I used it as a negative divergence. So the ratio between the S&P 500 and TLT, you can see put in a higher high. However, the SPX put in a lower high on the chart. Now, when that happens, we've seen sell-offs, boom, take place in the S&P 500. We're starting to see that sell-off now. Why am I pointing this out? Well, from a positive perspective, if this ratio cracks through this low, for example, right? So it'd have to come down into here. That could lend to a very similar type move like one of these in the white. However, you have to make sure that the S&P 500 does not crack this low for that to be technically that positive divergence. So before that's happened, bam, that called it, and then bam, it moved up. Right here it happened, bam, it called it, and then boom, it moved up too as well. So there's a possibility here that if this divergence holds as well, that'll be just another piece of information that we can use when placing an individual trade. Now let's take a look at the bond and yields market. I'm going to quickly go over this. Look at this. Spread between the 10 and 2 is just completely headed south right now. You can see the yields right here. Boom. They are like, this is the 10-year right here in blue. Okay. All right. No, is that the 10-year? Yeah, the 10-year is in blue. The 30-year is in black. The 20 is in green. This one's already inverted, the 30 and 20. The 2 is right here. The 10 is right here. So it's still far away from inversion. But if you were to look at this chart, you can see that it is still pointing down, heading towards that 0. And then the 30 and 5 also has been heading down lower too. So very, very interesting watching that these are just continuing to flatten out here. Now, from a fear perspective, right? What are people rushing into? What can you where's the safety at? Well, we're starting to see a breakout, right? We talked about the TLT breaking out of this previous range. And we said this would have to be probably some news type event to drive this. Well, there is some fears around that Omicron virus thing that's going on, but that could just be a catalyst. We don't know. So let's look from a technical perspective of how high this potential breakout can take us. Well, if you see here, it's breaking out of if you just look at the volume profile shelf, it's breaking out of where a lot of volume has traded. And then it kind of air pockets right here up into this range. So I would say that kind of lines up with, hey, if we just double this channel, that can bring us right back up into this range. So 160 to 162.50. I don't necessarily know, like this is a pretty aggressive move out of here. So it's very possible that we see this kind of take in a little bit, especially if we see the overall market start to bounce, and this might fade a little bit, and then we'll see what goes on from there. But you can see here, so far, we have this kind of scare, flight to safety move taking place. Let's take a look at commodities really quick. We'll take a look at oil, light crude. This is WTIC. So yes, we broke out. It's been seeing obviously increased volatility, big move to the downside. This is one way to look at it. Potential broadening wedge, and a broadening wedge, if it breaks down, it did a hold right there, but if it breaks down, it could take us to around 50 to 55, and that would line up with obviously prior support here too as well. So keep an eye out on that. But from a bullish perspective too, you can see here that price has pulled into already a previous area of previous resistance and support. So keep an eye out on that 60 level. If it breaks, we could definitely head down to 50 to 55. But if this holds, yeah, then we'll see what takes place, so we can potentially get a bounce. Now, if we get a bounce, what's the next thing that could potentially happen? Well, it might come up to 75, but if it starts heading back down, then we're going to start looking at a possibility topping pattern known as the head and shoulders. Take a look at gold. Gold is not doing anything, although it was up slightly, right? On the last trading day of the week. It's still within this range, right? Nothing really to report at this particular point in time. Silver. Silver has been getting crushed. We saw a little bull flag here, broke out, got rejected by the 200-day moving average, and now it's wedging again. We are right at that 22 level, this green line right here. and it's holding as support. It cracked it before, and we talked about this wedge, and we broke out to the upside. Now we are currently right back there again. So, if you want to add to a position thinking that we will eventually start heading higher and you're bullish, well, that's a good position to enter in from a risk to reward standpoint, because if we start cracking down 2150, well, then obviously we can head lower. And this has acted as support once, twice, 3 times, and now currently holding as 4. I will say the more times it's tested, the likelier that when it breaks, it could be more significant. And we are below all those key moving averages right now too as well. So what does that mean? It means to freaking be careful, people. Let's take a look at the dollar. Dollar up slightly on the week, relatively unchanged, still remains high. We've talked about this breakout type move, and the S&P 500, how it wasn't even getting, there was no fear. And now all of a sudden it was like a delayed reaction. We're starting to see some more fear. Okay, we'll see. We'll continue to watch this, see what happens. Crypto, everyone's wondering what's going on with crypto. It crashed. Well, the Sailor Shift tool obviously warned us about that. It's continuing to head lower. We're still right around 14. Volatility is obviously expanding. Huge range candle. Got down to a low of around 42.5. And everyone's screaming, buy the dip, it's a great opportunity. Hey, maybe they're right, maybe they're wrong. I guess we'll find out in, later down the road, obviously. But as it stands right now, I'm still personally waiting for this thing to turn up. There are some good stocks that kind of are within the crypto equity space that I've been watching that pulled into their 200-day moving averages that make for a good risk to reward trade. But don't try to be a hero, obviously, in that environment, because they can easily head a lot lower. Now let's take a look at Bitcoin from another perspective. So Bitcoin on the daily time frame, one thing to call out is we broke a trend line. And we are bouncing currently at the 200-day moving average. Now, if I were to draw a line like this, you can see it's actually back testing this area of support. So this could be just an early stage bounce. Like, we're starting to see a bounce right now, but who knows how high that can go to draw in more people and potentially head lower. So that is one thing that we need to be cautious of when we get trend breaks. From a relative standpoint, Bitcoin over SPX, it's been putting in higher lows, and we have not quite broken down that relative strength, but we're below that 50 EMA. So things are shaky, to say the least. Now, if you look at a little bit closer time frame, you can just get a zoomed in look here. Long lower wick. So bulls were ready to buy around that 44,000, 42,000 kind of range in here. And that lines up with what? It lines up with really these previous areas of resistance and support. So that makes sense. It was a good opportunity to see, if that was a very strong dip, we can potentially bounce up. But like I said, a couple things to call out here. RSI was putting in a negative divergence, and also the relative strength line was too as well, and we are still below that 50, obviously, EMA. So volatility has increased. If you got down here, awesome. But just know that volatility, it's not subsided yet, and it has a lot of work to do overall in this space. If we take a look at Ethereum, this is interesting too as well. Ethereum had a strong move out of the gates, and it was performing stronger from a relative standpoint. And look where we came down and touched perfectly into, well, it was a previous area of resistance, and this trend line was acted as an area of support for the buyers, and it came right back up in within this channel, this 4,000 to 4,800 range. So it's holding up right now. Now, another thing to call out, though, is this. From this point to this point, if you were to draw a trend line, it goes like so, a little bit higher actually, and you can see that trend also was broken. So if we start getting below that 50 EMA and it continues to hold down here, or maybe bounce up and then like something like that, just be mindful. So the price has a lot of work to do, and we're not quite, out of the woods yet. All right, everybody, that's all I have for you. So just to really wrap it up, what am I looking at in this environment? Well, first and foremost, I like trading breakouts, stocks that break out and move to the upside. However, with rising volatility, a lot of breakouts, they've been getting completely reversed. So it's very important to manage the risk. Now, if that is the case, which it has been the case, is you need to obviously step away from that strategy and let market conditions change back, and then that strategy will work once again. What works in this environment? Well, you can start looking for pullbacks, not to just buy the dip, because there is a difference between buying a dip, right, and catching a falling knife. So what I like to do is look for stocks that are above their 30-week moving average. A 30-week moving average has to be inclining. Price has to be above it, and you want to see price pulling back into around that range, because that gives you better odds. You're buying a stock that's in an uptrend, right? Potential stage 2 uptrend, if you know what that is, right? Stocks go through 4 stages: accumulation, markup, distribution, decline, and then over again back to the accumulation phase. Okay, so what you want to do is if you're trading a stage 2 trend and you're getting a pullback, it obviously goes like this, boom, 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 boom. And then you go through these wild swings periods of distribution. Okay, that's the various cycles. So if you were pulling back into a 30-week moving average that's inclining, that would at least give you a better odds, better risk to reward trading that way. Now, there's a lot of stocks that are well below their 30-week moving average and well below the 200-day moving average. It might be curling over. So right there, that's the difference. If you were to buy these ones, I mean, you're trying to catch a falling knife at that point, right? You're already in bearish context and you're hopping into something. And keep in mind, right, stocks, they can head lower. We've seen this. Look at PayPal. PayPal moved, put in like right into an area of support, then it got cracked even lower. We're seeing things like DOCU, DOCU, getting completely obliterated. Yeah, you can get lucky and you can get these, catch bounces. So if it's shorter term bounces, that's one thing. But if you're looking to add, to certain positions, just, randomly out of nowhere, you might as well put odds in your favor. And to put odds in your favor, you want to make sure that the obviously context of the chart is bullish like so. Another thing is if you're an options trader, buying just puts and calls in this environment, very difficult. So one thing that I like to look at is, if you're intraday trading, although it might be difficult, obviously with raising volatility, that's one thing. If you're taking a directional bet, so if the stock is pulling down into an area of support and you think that it's going to bounce and you want to trade options, what you can do is you can trade directional spreads, and then that'll help reduce your risk. Another thing with volatility being so high, obviously selling premium is another thing that you can do. If it's going to be your first time ever selling premium and you're unaware with it, I don't just step into something like that. You need to really learn and understand all the risks involved with selling premium. That's all I got for you, everybody. Hope you have a wonderful weekend.